we are in the middle of the fastest raising interest rates in the history of our countries. I've curated a couple of the very interesting sentences to tell you how this is going today. A lot of big government announcements, State of the Union, all kinds of things come up, and it doesn't affect people's lives too much. But what really hurts is when the bank is raising rates and it's costing you thousands of dollars extra every single month. And everybody is hanging by a thread right now and paying attention to what the central banks of the world are saying when it comes to interest rates. We are in the middle of the fastest raising interest rates in the history of our countries. So to look at this, to say it would be an understatement of how serious it is. Now, the Federal Reserve of the United States, now they control all the finances of basically the whole world because of their reserve world currency. Now, I am in Canada, but I can see the United States from my building, okay? Sound like Sarah Palin. I can see Russia from my house. But I mean, it runs everything. So we have to pay attention to this because the rest of the world kind of follows suit a few weeks after the United States gives their direction. So they always say the United States catches the cold, the rest of the world will catch a flu. Well, there is some good news and some bad news coming out what he says. I've curated a couple of the very interesting sentences to tell you how this is going today. All right, let's check out his beginning of his statement.
Before we go into the details of today's meeting, I'd like to underscore for the American people that we understand the hardship that high inflation is causing and that we are strongly committed to bringing inflation back down to our 2% goal.
2%, everybody.
Over the course of the year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our rapid tightening so far are yet to be felt.
Do you see that? He says it's not felt yet. The massive lag that we always talk about is still coming. More damage is coming.
Even so, we have more work to do. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 0.5 percentage point. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time.
Okay, guys, that is a lot of information just in that couple sentences. So today he is raising the rate by 0.5%. Okay, number one, and to make money restrictive enough, so not available to anybody, in order to bring inflation down to 2%. Notice before he even started talking, he said, we're getting inflation down to 2%. He also says many, many, many times through the meeting, we're coming back to 2%, coming back to 2%. So they are going to do that. Now, here is the weird part. The mandate of the Federal Reserve or any central bank of the world is to have full employment and have stable money, meaning no inflation. But remember, the government has already printed all that money. It's now up to the job of the Federal Reserve to pay that bill. And now the bill is being paid by all of us who are having these high interest rate hikes. Now, this is going to continue on and on for all of us, and we have to be careful about this. But notice, he says we will keep going until it hits 2%. So they're raising it 0.5% today, but it has further to go, a lot further to go. I'm not going to be surprised to see 10% mortgages happening in the United States for a 30-year fixed. This is going to happen. But he gives a lot of clues about that coming up in the next couple excerpts. All right, now let's talk about his change in GDP.
The labor market remains extremely tight, with the unemployment rate near a 50-year low. Job vacancies still very high and wage growth elevated. Job gains have been robust, with employment rising by an average of 272,000 jobs per month over the last 3 months. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers.
Do you see that? Out of balance labor.
The labor force participation rate is little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices.
All right, you guys, we have to pay attention to that one part because it actually is quite sinister if you believe it. So the labor market is out of balance. You know, we hear that and we don't actually understand what the meaning of that is. There's too many people with jobs. So what happens is when employers are desperate for workers, they're going to put out higher wages to attract those workers. Now, you think that higher wages sounds like a good thing if you're a worker. Here is the problem. If you do pay them more, now they have more money in their pocket to go and spend, and inflation continues. He said many times in his meetings, the quality of life has to go down. We need that pinch. So they need a lot of people to lose their jobs. The job market is out of balance. So here is the only two things that they could do. So number one is the government could mythically go and create Amazons everywhere and hire millions of people, like create jobs to fill them, which is impossible. Or number two, they can make it so hard on everybody that everyone loses their jobs. Now, a government could do that really easy by raising those interest rates up really high, could bankrupt a lot of people, bankrupt a lot of businesses, and then the labor market is in balance. So we have to understand what those words mean when he says it's out of balance. And he has spoken many times, but the problem is that when we're giving higher wages to the employees, they have more money in their pocket, and that's what's continuing inflation. So he all out but said, don't give your employees a raise, which is tough to swallow. All right, my friends, here is
The
inflation.
median projection of the SEP for total PCE inflation is 5.6% this year and falls to 3.1% next year, 2.5% in 2024, and 2.1% in 2025.
Woo! Okay, guys, so this is important for us to pay attention to. Can you see this really well on your screen? So where is inflation today? Inflation is sitting, according to their numbers, in the 7% range. Now, they may be talking about core, and core is around 6%, if they exclude food and energy, which is crazy. You should always include that. But notice where their projection is. They said, we will not loosen rates until we hit 2%. Notice this chart here that it's going to be above 2% in 2023, above 2% in 2024, and only hit there maybe in 2025. So just break that down for me in your mind here. They have said that inflation will continue for the next several years. That means that the interest rates have to stay high for the next several years. You see what I'm saying? This is the guidance they're giving us. Now, do I think that's actually going to happen? The bullwhip effect and all kinds of different things are happening right now, cross currents. I think 2023 is going to be really rocky. They're going to be forced between a rock and a hard place to lower that. But let's talk about the guidance that they're giving us today, that those rates are going to stay a lot higher for a lot longer. All right, guys, let's hear it straight from the horse's
We're
mouth.
continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.25 percentage points this year.
Highest in
We
history.
continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time.
Did you hear that? Is that he's going to continue to raise rates. We have to understand that they're talking about raising rates another 0.75% now. But we have already seen the beginning of the pivot. How bad can it get? That's what our question is. Can there be more damage in the economy? Higher prices, more foreclosures happening? Because as of now in Canada, 99.5% of people can still make their payments, but not for long, right? Your savings are getting drained out. Now, let's go see what Mr. J. Powell himself is saying about that.
Such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 50 basis points today, a step down from the 75 basis point pace seen over the previous 4 meetings. Of course, 50 basis points is still a historically large increase, and we still have some ways to go.
All right. So do you guys see that? And this chart, this is very, very important for you to see. Number one, he's saying that the rates have to continue. The rates will continue to go up. Okay, but how high is the question and how long is the question? He just said there, we have to be at it for a long time because of the lag effects. Remember, when an interest rate goes up, it takes 12 to 18 months to actually show up in the market. Remember, this is like a monster ship with a little rudder at the back. They move that rudder, they move that interest rate, and it takes a long time for that big boat to turn. And that's what's happening right now. They raise the rate, and it takes time to turn. So he just said there, they're going to have to raise the rates higher and keep it that way for longer. Now, how high will they go? But remember, they've raised it every couple months now for the rest this whole year. And every year they keep raising the amount of how high they think it has to go. So if we take a look at this chart right here, they're telling you that right now in 2022, they were expecting it to stop at 4.25. But now in 2023, they're expecting it to be at 5.1. And if we look outward, look at where they think the rates will be in 2024, around the 4% range. If we look out in 2025, still 3%, and maybe coming down to 2.5% in 2026. Now, that is what they're telling us. But again, every time they have these meetings, they want to be very careful and tell you we are adjusting every single time, every 6 weeks, until we get all of the information that they need. So they're going to take a break until the next meeting, until February or so. But remember, a lot of the other economies of the world, if it's Canada or Australia or Europe or whatever, they're all watching what the US Federal Reserve does. And then they kind of knock down that policy to the rest of them. They don't always copy exactly, but in Canada's case, it's in the high 90% chance that we'll copy the United States. Always in the direction, but not always the exact same number. They may raise the rates 0.75 and we might raise it 0.5. Here is the good news. We have seen the first step of the Fed pivot. Remember, the Fed pivot comes in 3 sections. Number 1, they will slow down the rate of increase because they went 0.75, 0.75, 0.75, 0.75, and then now 0.5. The first step is smaller rate hikes. Second step is just raising it 0, not raising it at all. That's the pause. And then the third step of the pivot is where they actually start cutting it. All this stuff on YouTube where they think the next day they're just going to pivot and drop it back down to 0 is not going to happen. Think of what actually had to happen for that to happen, right? The whole cerveza sickness had to start and drop the world into this thing that we've never seen before. So we have to be careful in not to expect that rate to come back down. This is what they're telling us. But if we are between a rock and a hard place next year and a massive financial contagion happens on worldwide markets, they're going to have to react differently. But one thing that he keeps mentioning is that they're going to continue to monitor it every minute, every day, and then every 6 weeks have a fresh new start. So if we take anything from what's happened over the last 9 months, they have always had to up their guidance in the next meetings. So let's hope that their guidance stops at the 5.1%. All right, please pay attention to how he defines inflation.
You can break inflation down into 3 sort of buckets. The first is goods inflation. And we see now, as we've been expecting really for a year and a half, that supply conditions would get better and ultimately supply chains get fixed and demand settles down a little bit and maybe goes back to services a little bit and we start to see good.
Okay, did you see that about goods? All right, so toilet paper is not $100, but it's not because people don't want to buy this stuff. Right now, they're broke because they're spending so much on inflation. So, of course, people don't have a lot of money to go buy stuff. If we're going and looking at any stores right now, there's material like stock of everything stacked up in the middle of the aisles. There's stuff everywhere. Goods inflation is the first bucket that he's talking about. Okay, second bucket.
Goods inflation coming down. We're now starting to see that in this report. Then you go to housing services. We know the story there is that housing services inflation has been very, very high and will continue to go up actually as rents expire and have to be renewed. They're going to be renewed into a market where rates are higher than they were when the original leases were signed.
All right. So this is a lot to unpack, but I'm glad that we're doing this together. When we're talking about the housing prices have come way down. In my city, it's down 25% for houses. And so why is he saying it's coming down, but then it's going up? Because the CPI in the old days used to be measured by housing prices. Now they use owner's equivalent rent, which is a scam, I think, but they're just saying, how much could you rent it for? But rent prices are going up and home prices are going down. So if you own your home, you could sell it for a lot less. If you want to help sell your home for a lot more money and do it a lot faster, that's what we specialize in. You can always reach out to me. But if you want to look at rental prices, rent prices are going up to the moon. And that's where it's going to be hitting in housing. So let's continue. It's the third bucket I want to talk about.
We see that the new leases that the rate for new leases is coming down. So once we work our way through that backlog, that inflation will come down sometime next year. The third piece, which is something like 55%.
The third piece, most important.
Core inflation index is non-housing related core services. And that's really a function of the labor market largely. It's the biggest cause by far in that sector is labor. And we do see a very, very strong labor market. One where we haven't seen much softening, where job growth is very high, where wages are very high, vacancies are quite elevated, and really there's an imbalance in the labor market between supply and demand. So
that is so important. So do you notice that he's mentioning that is a problem? It's a problem that too many people have a job. It's a problem that everyone has had a pay rise because that is leading for inflation. Too much money, higher wages in the pockets of too many people, and they're still going and buying stuff. This just rubs him the wrong way. He can't handle that. So when they talk about putting it into balance, remember what that means. Lower pay for people, less jobs, more people laid off. It's like it's stubbornly high for him. He's trying to get that to go away. And that's where you're going to have to wrap your brain around that, because you would think that it's great to have higher wages, more people working, even though that is one of the mandates of the Federal Reserve. Remember, this is this pull and tug that's happening for them. Their mandate is stable money, high employment, but they can't have both. That's the crazy part right now. They have to sacrifice one or the other. Either you have to have 15% inflation every single year, which is unacceptable, or have a lot of people lose their job, which is unacceptable as well. But they have made their choice. They have to save the dollar and not the jobs. So they're doing everything they can to protect that dollar, which is kind of crazy, right? If you think about it. All right, let's get back to him and see what he has to finish off with.
that part of it, which is the biggest part, is likely to take a substantial period to get down. The goods inflation has turned pretty quickly now after not turning at all for a year and a half. Now it seems to be turning, but there's an expectation really that the services inflation will not move down so quickly, so that we'll have to stay at it. So that we may have to raise rates higher to get to where we want to go.
All right. So just try to unpack these with me. That he is saying now, yes, after 9 months of interest rate rises, we have finally started to see the change in prices. Okay, check mark for them after all of this work. All right, but labor market hasn't changed at all. So he's going to say this even lags even farther. They're going to have to keep raising rates higher, like he just said, until the companies can no longer afford those employees and lay the employees off. It sucks. This is a financial war. It's not a hot war, where two countries are fighting and people die. But this is a financial war where there's going to be casualties. And unfortunately, there's going to be a lot of people that have to lose their jobs, see unemployment go up before we have this all settled down. Of course, there's a lot of cross currents that is happening all the time with the Russian war and supply chains and all and so forth. The BRICS countries coming apart. We have other videos that we've done on the BRICS countries. You can click on them right here. Anyway, you guys, I'm always there for you. Listen, the next 2 years are going to be really, really rocky for a lot of people. But if you pay attention, follow me, we're going to be able to make the next 2 years turn into the best 2 decades of your life on the way out of this. I'm always here for you. Please consider liking and subscribing to this. If you like this kind of content, please leave me a message below and tell me what you do like of it, what you don't. And if you know one person to send it to them, we'd really appreciate it. Thank you so much. Hope you earned your subscription. Have a good day. Thanks so much for sticking around. If you like that video, you might like this one and maybe something like that.